So let me take a step back because I should have shared this before as we started this. As you're thinking about the financing of your business, your job is now you wear this hat as in charge of funding for your company, is making sure that you have capital funds available where you need the money in the right place in your business, when you need the money. Timing is very important, and in the amount of money that you need, making sure you get enough capital for your business, where you need it, when you need it, in the amount that you need it. Okay, so we went through the 5 C's of lending: character, capacity, capital, collateral, and conditions. So now I want to share with you the 10 do's and don'ts of raising capital for your company. Let's start with the do's. Okay. Always raise more money than you think you'll need. What I find too often, companies, when they go to borrow money or even look for investors, they don't ask for enough money. They don't anticipate how much money they'll need in the next 6 months, the next 12 months, the next 18 months. So one way to avoid that and protect yourself is raise a little bit more money than you think you might need. And most bankers understand this. Most bankers would rather give you more than less because they don't want you coming back a second time, a third time, a fourth time. Okay. Run with more than one horse. There was a time that I'm not sure I would have suggested having two banks or two different investors, but I think in today's world, it's a pretty good idea. Let's particularly thinking about banks. One, because we've seen over the last decade or so, number of banks have gone down significantly, whether they've gone out of business or they've merged, whatever the case might be. And because it's become more difficult for them to make loans, we're never quite sure that we can get approved for a loan, even from our own bank. So that's why more and more, I think it's a good idea to have relationships with more than one bank. And if you're using equity capital, more than one investor. Okay. Knowing that banks do not like that. Banks want to have all of your business. They don't like the idea of you working with more than one bank, but that's not necessarily in your best interest. Recognize that the cost of capital, what you're going to be paying, sometimes goes beyond the economics of the term sheet. So when you go to borrow money from the bank, they're going to provide you, upon approval, they're going to give you a term sheet. That term sheet is going to give you all the specifics of that loan, how much money you're borrowing, what's the interest rate, what's the terms of the loan. And know that while they may say, okay, the interest rate on this loan is 6%, it's very likely that your actual cost of capital will exceed that. Well, why would that be? Well, you might have legal costs. You might have accounting costs. They may require you each year to get a review of your financials. That's going to cost money from your CPA. There may be certain service charges related to your bank. To renew your loan, there may be a charge that the bank has. So just know that whatever they say you're going to be paying, 6% as an example, no, it's very likely that you'll actually end up paying slightly more than that. Remember to tell your story, do so clearly and succinctly. So when you go to borrow money, remember we've talked about the idea of telling good stories several times over the course of this program. When you go to the bank, a big part of your ability to acquire funds is going to be your story. Why do you need this money? For what purpose do you need this money? How will the money be used? How have you used capital in the past? So it's important that you create and tell a very good story. Be prepared to tell a very good story when you go to the bank. Okay? Know the market, know the source. Know that all banks are different. Some banks are more likely to lend to small businesses than others. Some banks are more likely to lend to certain industries than others. Some banks, even in certain markets, that a bank, Bank of America may be more likely to lend money in Houston than in Atlanta. So it's important and incumbent that you, as you're looking for capital, that you understand the market, know who's lending money, know who the SBA lenders are, who's more aggressive in terms of their interest rates. And even within the bank, good idea to know who the lenders are. I'll never forget the first time that I went to borrow money for my business. I had been doing business with this bank for a couple of years. This was a travel agency that I owned. And every quarter, I met with my banker, showed him our financials, no surprises. After about 2.5 years, I went to the bank and requested a line of credit because we were growing. My accounts receivable were growing. I needed additional capital. So I went to the bank and asked for like a $15,000 line of credit to help with my accounts receivable. The banker who I'd been dealing with for all that 2.5 years said, great, let me write this up and we'll see if we can get this approved. Week or so passes. His name was Joe. Joe comes back to me and says, Tim, bad news. We cannot approve your line of credit at this moment. Very sorry. Thank you for being our customer, though. Wow, I got rejected. Come to find out, Joe had been in banking for quite a while, 30 plus years. In that 30 plus years, he had only had one loan defaulted. One loan in his entire career went bad. What type of business do you think it was?
Construction.
Travel agency. I never had a chance. I never had a chance. Now, that was on me. I should have asked ahead of time, Joe, have you ever lent money to a travel agency before? Should have asked that question. I didn't. Bankers have long memories. He was never, ever, ever going to approve that loan. Wasn't going to do it. Know the market, know the source.